break down how to actually get approved for that Ferrari. So stay tuned for it. I'm excited. Hi, welcome to my channel. Oh, you guys clicked on because you want to know why drivers therapy's loan application got denied.
What?
Oh. And who's more better to equip to answer this question than the credit analyst of YouTube. My name is George. I approve loans for a living and help people build and restore their credit. So you guys are into a nice little treat. I'm gonna break down the reason from a person that's in the inside and gonna give you some little secrets, tips on and explain why he did not get approved. And if you're watching driver's therapy, you're welcome. No. I definitely check him out. I'll put his YouTube in the link description below. If you're huge about being passionate for cars, DIY for your cars, modification for your cars, interviewing people that have also a big passion, go over to Driver Therapy's YouTube page and show him a little love. Let's go ahead and help him out. And if you're new to the channel, welcome.
Hey, get your numbers up. I had to get my numbers up.
And anybody that's already been subscribed, thank you very much as usual. Remember, I'm always here to answer your credit and your loan questions you have. Just put them in the comments below. And last thing before we get started, let's get over, the housekeeping. I have to. So if you need help with your credit, I'll put a link on where to go ahead and schedule me, and my credentials will show up here around the screen, so you can go ahead and see where I have worked as a credit analyst or a consumer loan underwriter. We go by one of those. All right. Well, let's go ahead and jump right straight into it. Let's do this. We're gonna go ahead and start off here with the video.
Experience with Woodside Credit was initially when I was looking at a Ferrari F430. I actually got the email to a person at Woodside Credit from the person who was selling the F430. And some of the things that the representative at Woodside Credit was talking about is that they offer higher loans, but typically they need a down payment and they have competitive rates. At the time, I decided...
All right, I'll go ahead and confirm that. That is very true. You do need to have 10 to 20% down, or even, I'll just say this, you need sometimes up to 40%. A lot of different factors will fall into the reason why that is, but let me at least co-sign and confirm. Even where I work at right now, if you want to get a car that's over $85,000, they want you to put down a 10% minimum for those type of cars. So yeah, let's go ahead and continue. Just wanted to do a little side note.
I didn't go with USA, so I did not apply with Woodside Credit at that moment. But here recently, I did. And the reason why is because one of my friends is considering selling his Lamborghini Huracan Performante, and it's about $300,000. And at the time, I just sold my McLaren MP412C. Now that McLaren MP412C, we originally got a loan through USA and we paid it off in less than a year. So we had the title to the McLaren, and when we sold it, we had the capital and the full sale price to use. So when I applied to Woodside Credit, I asked for about $123,000, $130,000 because I was going to put down the rest towards the car, and we had the 20 to 30% that they require. So I applied and I got denied. And the funny thing is, if they would have called me, I would have told them that I was putting 20 to 30% down because that's what they recommended, but I was also willing to put down more money, but they just clearly said no. And the interesting thing is, when I got their paper,
let's go. Here's an interesting thing from my end. I don't know why they missed out and didn't reach out. That should be kind of a normal procedure for loan officers to reach out. with loan declines, because again, you miss out on situations like he's mentioned. He said he's willing to put down more, like 40%. Ooh, that is a credit analyst and a loan underwriter's dream. You're telling me you're gonna put down 40%? Yo, there's not a lot we need to do. There's not a lot well, also there's other still things that fall into this, but
congratulations, you played yourself.
yeah, I was like, that one's tough. They definitely should have gave him a call.
A lot of the reasons why they denied me was more of a computer denial, like an algorithm. I've had history.
Okay, that is exactly what I was looking for. Okay, I'm so glad he showed this paper. All right, so for the people that have applied for loans, you guys are familiar with receiving this type of document. So it says pretty much, thank you for your application, your request of 131,000. After reviewing your application, they weren't able to go ahead and approve you for the reasons. And these are the two reasons. We have high debt ratio. Right now, I'm only going based off the context that driver's therapy went over. So if you definitely want to go, we can definitely collab and can go a little bit more in depth. But I'm just only going based off the information I have in front of me. So that's the only best thing that I can do. So essentially, so when it's referring to high debt ratio, that's essentially also your debt to income ratio. But essentially, as you see on the screen, he says, I only owe on my house. Income has never been an issue. So again, it could be a couple of things that I'm thinking about. So essentially, when you're in a high debt to income ratio, essentially they just see that a lot of your income is going towards your debt, and it could be maybe going, a lot of your income could be going all towards your debt. Again, these are just all the possible situations. It's just not all of them. Another one that can be is the income that you may be receiving could be maybe lower than what's expected to be able to repay the loan, or it can be in the negative, for the sheer fact, because when it comes to taxes, the way that taxes get analyzed when we're reviewing a loan application, so if you file what's called a Schedule C, which comes with your 1040 tax return, essentially we take line 31. Whatever's in line 31, that is essentially what you made. Think of it like your paycheck. So on the top, you have how many hours you made. The middle is all the deductions and the expenses. So like you pay for healthcare, FICA, 401k if you contribute, and then you have your net pay, which is pretty much what's going to go into your bank account, right? That's how it is with a Schedule C. If you're filing like a 1120 S corporation, which again, I'm not too sure what, driver's therapy, if he's the only owner, but if he is the only owner, we will go through what is listed on your 1120K1. So essentially the 1120K1 will show on line 16D, and we have to see a D. That means a distribution. There are a lot of different lenders from where I've worked at that will use the business ordinary income, but there are some that won't. Like one of the banks that I worked for, they wanted to use what was on the K1 as opposed to the business ordinary income, because the business ordinary income is what pretty much is the money that was left after all the expenses. So in a technicality, not in a technicality, it is the person's income, but the way that we have to view it is if it's not being distributed to the person, then we won't count it. We'll have to do like an additional analysis to go ahead and do that. So essentially what we do is a quick ratio, which we try to analyze your balance statement, so pretty much your assets and your liabilities. And we can go into that further in a different video. And another thing on your business tax returns, I think it's line 9, that is compensation to officers. That's another place where we can use income That's where you're owner of a company, but then you pay yourself a W-2 employee. So that means you have taxes and all that stuff that gets taken out. So then your own company will issue you a W-2. So that is another reason why it could be, due to the income. Another reason that would be high debt ratio. So typically, a high debt ratio would be anything over 55%. Where I work at right now, they're at 65%, which is crazy. I've never had it be that high. I've always had it 55, and then I've been exposed to 60% debt to income. And just in case, if you don't know how to calculate your debt to income, it is pretty much your debt, all your debts on your credit report divided by your income equals a percentage. The other one, that's insufficient income for amount of credit request. So this, I think, a majority of the decline came from. And you also, driver therapy, you mentioned it in the video, which now it helps them build a better picture why they declined you. So essentially, you don't have any comparable credit when it comes to those high type of loans. I know. It's like people, and maybe yourself, you're like, wait, but I mentioned in the video that I had a loan with USAA, and I did hear that. Don't worry, it's not like I didn't hear it. But the thing is that when it comes to loans and what we have to look for and what we've been trained for, we're looking for over a period of time. Having a loan over 100,000 and having it for less than 12 months doesn't really show established payment history, which is the most important thing when it comes to getting a high-end loan, right? So that's what I'm thinking. And the reason why he was able to get approved through USAA is because he already had a $100,000 loan. But it wasn't because he already had the $100,000 loan. It's because he already has a relationship with USAA, and because of that, in all the products and the services he has through them, and paying off that $100,000, and especially under 12 months, they were like, we know this guy's gonna pay us back. He's had several loans, I imagine. He's had several loans with him, where he's paid them off, and this is one of them. So they're gonna trust him. This is why Wood Credit didn't give it to him, but that's the reason why USAA went ahead and gave him the loan. The other thing that I'm gonna say is this is gonna be kind of like a indirect effect. So I have a news article here from last year. Ever since even a couple years, the underwriting has tightened up. So you have Capital One, Ally, Santander. They are tightening. Oh, can't even see this article. But essentially, in this article, it talks about how they're just tightening on their underwriting. So maybe they reduced their loan to value. They may have decreased what their debt to income is. They want a higher credit score. So all these things do play a factor, these external factors. Whenever they're seeing high delinquencies, which is what's happening, is that there's just a lot of people getting their cars repoed. I've seen so many credit reports where Santander is just getting repoed left and right. Navy Federal is getting charged off a lot. So a lot of that stuff does play, because again, with high exotic cars, they're more of a luxury item. They're not like, oh, you need it. Like, you need a car, but you don't need a Lamborghini. You don't need a Ferrari, but you do need a Honda, right? So that, those small little things do play into a factor. So that's what I'm thinking is really what majority went on. When it came, they just saw that you didn't have that, and maybe, again, I also forgot to mention the value of the vehicle. It could be, the amount that you were putting. Maybe still the loan to value may have been high. Again, these are all potential possibilities. I just want to lay out all the reasons that it can be. So yeah, let's go ahead and finish this video because it's almost done. It's definitely be very interesting.
It's more of a computer denial, like an algorithm. I've had history in my credit where I've purchased high-end cars and I've paid them off. So in my opinion, I think that Woodside Credit is either using an algorithm or their underwriters weren't really taking time to help a potential good customer. So really, at the end of the day, I decided to see if maybe it was just Woodside Credit and if somebody else would deny me. And I went ahead and applied with USA and they approved me for a loan. But I thought I'd share with you guys my experience. Let me know your experience.
All right, well, there you have it. That is the reason why he's right. He's at least right when it comes to the system. We do have an underwriting system that would review it. Based off how the director of underwriting does the algorithm for it, it can automatically decline you. But I know it's not based off trade lines. It doesn't look specifically on your trade line. So what I mean by that is like, oh, he had a loan with JP. He had one with Chase. It was for an auto. It was joint. It doesn't go into that detail. It's more of surface level information. Oh, he had a loan for this amount. Okay, how long did he have it? So things like that is what the credit algorithm does look at. Other things, he did mention the underwriting. That's also a thing. There's different, unfortunately, cultures when it comes to underwriting. This is something for you to know. So they cater to a certain demographic that can also pose a problem, but also can oppose a problem when it comes to regulation B, because you're supposed to provide credit equally to everyone regardless of what your culture is when it comes to underwriting. And then I just want to leave this last thing. I actually did find a video through their website through what was it, Woodside Credit, and I wanted to go ahead and touch a little bit more bases on it. But what I think this video has been long enough. I'll say that for the next video because I'm actually going to break down how to actually get approved for that Ferrari. So stay tuned for it. I'm excited to work on that video. So definitely, if you're new to my channel, welcome. Driver therapies, please reach out to me. I would definitely love to collab and get a little bit more context so I can give you a lot better answer. And I'll see you guys in the next video of how to get approved for Ferrari. Let's do this.